Hey everyone, Dan again, stocktrades.ca, back at you with another video. A little different this time around. What I'm actually going to be going over today is the tax-free savings account. What the TFSA is, how to use the TFSA, and at the end of the video, I'm actually going to go over one critical mistake that investors can make here in Canada that could end up costing them nearly $700,000 in this account. So you're gonna wanna stick around till the end of the video. There's a ton of information to go over in a very short amount of time, so let's get started. So to kick things off, what is the TFSA and what does it stand for? TFSA stands for Tax-Free Savings Account. The account was declared in the 2008 federal budget, and the first year it rolled out was in 2009. Canadian investors were given a $5,000 limit. That $5,000 limit carried on for 3 more years until the government upped the rate to $5,500 in 2013. That carried on for only 1 more year until 2015 when the contribution limit was nearly doubled to $10,000 for a 1-year period. In 2020, the contribution room is $6,000. So if you were 18 years of age in 2009, you're going to have around $69,500 worth of room. Contribution room essentially starts when you were 18 years old. So somebody who turned 18 in 2009 is going to have $69,500 in room, but somebody who didn't turn 18 until say 2015 is going to have less room. The easiest way to check your room is just to create a MyCRA account, log in, and it will just show you your tax-free savings account contribution room. So being established in 2008, the tax-free savings account is actually a relatively new account. If we look to the RRSP, or the Registered Retirement Savings Plan, this account has been around since 1957. The United States has actually had an account like this since 1997, the Roth IRA. And it's very similar to the tax-free savings account. And the easiest way to describe this account is it enables Canadians to build tax-free wealth over a long period of time. Now, the number one thing that tricks beginner investors, and it's actually right in the name, is savings account. Yes, the tax-free savings account can be a great way to build savings, but the fact is, using a completely tax-free account to invest in, say, a GIC or a money market fund is just not the way to go about things with this account. You're not going to pay much tax on these investments anyway because they don't earn that much. And especially in the low interest rate environments we're in right now, dividend stocks and stocks in general are going to outperform. So yes, this account can be used as a savings account, but the optimal way to use this account is purchase Canadian stocks, Canadian ETFs, and even ETFs that track international stocks that trade in Canadian dollars. There's one stock that I didn't mention and you might have noticed, and that is US stocks. And why do we not suggest investing in US stocks, particularly US dividend paying stocks, inside of your tax-free savings account? That's because, contrary to popular belief with this being a tax-free account, is that there is still withholding tax charged on US dividends inside of your tax-free savings account. The US government has agreed not to tax dividends on accounts here in Canada that are meant to provide tax-deferred retirement or pension benefits. The RRSP is a perfect account for this. US dividends inside of the RRSP are tax-free. Within the TFSA, they aren't. Now, contributions to a TFSA are not tax deductible. This is another thing that investors get confused with their RRSP. If you contribute $3,000 to a RRSP, that money can be taken off your income tax and you can get a tax return for that money contributed. The tax-free savings account has no taxable benefits in terms of your income. The primary reason for this is because the money can be withdrawn tax-free as well. You will never pay tax on money inside of a tax-free savings account unless you've got a little greedy, started day trading, and now the CRA is asking you to pay tax on that income. So another common misconception with the TFSA is the fact that you need to have filed taxes or have an income for that year to be granted your contribution room. And that is false. You get that contribution room no matter what, as long as you're over the age of 18 years old. Unlike an RRSP, where your contribution room for the next year is based on your previous year's income. Now, the number one thing that tends to trip up beginner investors with the tax-free savings account is contribution room. Not the amount of contribution they have, but how a withdrawal or a loss within the account will affect their contribution room moving forward. And the best thing about the tax-free savings account is if you managed to make some solid investments say you've maxed out your tax-free savings account at the $69,500 mark, and you've grown that to around $100,000. You don't need to be scared that if you withdraw any money that your contribution room will go back down to $69,500, because a contribution room in a tax-free savings account is actually pretty easy to calculate. It's your past contribution room plus your previous year's withdrawals plus the government's allotted amount for that year. So if you withdraw $40,000 out of that TFSA in 2020, in 2021, you have the opportunity to recontribute that money. Your contribution room won't go back down to your original amount that you've been allotted by the government. You have that year to get that money back into the account where it can continue to earn tax-free. Now, the second thing that trips up beginner investors, you can have more than one TFSA account. You could have 20 of them, 25 of them if you want. I mean, obviously I wouldn't suggest it, but you can do that. The only thing you can't do is combined out of all those accounts go over your contribution room. To keep things easier, I would highly suggest sticking to one account, one tax-free savings account. Where I hold my TFSA is Questrade. And if you want, I'm gonna leave a link in the description and a little pop-up on the video here. If you use the code StockTrades50, you'll get $50 in free commissions as long as you make 10 trades within your first month. So final tidbit of the video, and quite possibly the most important, the moment you've been waiting for. How is this account that only has, a maximum of $69,500 in contribution room, how can that cost me close to $700,000? As I mentioned before, money earned can be withdrawn and recontributed the next year, so your contribution room can increase. But the fact is, it can also permanently decrease. A lot of investors take a hyper aggressive approach inside of their TFSA because they think they want to hit that big stock. They want to take a dollar stock and ride it all the way up to $100 and sell it tax-free. They're gonna be rich. But the fact is, more often than not, if you take this hyper aggressive approach, you're just gonna end up broke. If you just turned 18 last year, you've got $6,000 in contribution room, and you decide to buy some over-the-counter pink sheet stock with your $6,000, and the company goes bust or the company loses, 90% of its value, you don't get that loss back the next year. If you deposit $6,000, lose that $6,000, the next year, you're only gonna have $6,000 more, not 12. If you maxed out your TFSA for the $69,500, in 30 years, if you invest that in stocks, bonds, whatever it may be, and you get an 8% annual return, that $69,500 will turn into almost $700,000 over the 30-year period. I know this is extreme, but it is a prime example. If you take that $69,500 and buy highly volatile penny stocks with it and lose 90% of that money, you'll have to earn tax-free returns on whatever you have left in the account. The tax-free savings account is not a place for high-risk investments, primarily because of the reasons I just explained, but also the fact you can't claim a capital loss in a tax-free savings account. If you had a margin or cash account, a non-registered account, and you lose $30,000 on a penny stock, you can counteract any capital gains with that because it's a capital loss. Inside of a TFSA, there is no taxable benefits to losing money on investments. And this is one really important thing to consider. You don't have to pay capital gains on returns, but you also don't get the benefit of claiming capital losses. That, combined with the fact that you can permanently lose your TFSA room, is one of the primary reasons why I do not suggest a hyper-aggressive approach within these TFSAs. That's pretty much it. It's a very simple account. It is a great account to earn tax-free investment returns, but is also a very easy account to screw up and permanently damage. Guys, I hope I could explain this in as short amount of time as possible. I hope you know what the TFSA is and how to use the tax-free savings account. If you do, help support the channel with a like, with a subscribe, drop a comment below. It helps us continue to make great videos. I mean, as of filming right now, we've only produced 25 videos and we've gathered over 4,300 subscribers, which is amazing. And we definitely plan to bring you more great investment content on this channel and on stocktrades.ca. We hope you liked the video, and we'll see you next time.